Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. The turn-up at the end of February / beginning of March was both surprising and amazing, as we really had no further support below until the 61.8% absolute Fibonacci line at 1106. So, from the December 2020 low, prices turned back up, pushing through congestion in the 1161 area, then 1161 to 1177, the 2021 low at 1181, the May 2023 low at 1193, the December 2021 low at 1223, and most recently the mauve highlighted declining medium moving average, currently at 1200, before utilizing as a base for the latest move higher since mid-May. To add to the discussion, I said the following 8 weeks ago, and I quote, "The one thing such a move higher might start is discussion if the November 2023 to date action is a potential descending scallop pattern. The only other thing to bear in mind is not here on this daily chart, but in Chicago soybean meal, and that is the well highlighted annual key reversal down we saw there for 2023. Not directly related here, but not worth ignoring either." End of quote. On the point of a descending scallop pattern, I said 3 weeks ago, and I quote, "If prices were to continue lower down to the 1130 area and then hesitate before breaking further down, well, that would fit in with the pattern. The alternative is an almost immediate return higher and quick break." End of quote. Well, much as I thought we might be heading lower, prices instead have taken a turn higher, enough that we are on the verge of creating not just one, but possibly two patterns. Firstly, we have the potential descending scallop pattern with an upside move seemingly in operation. This gives a primary target in the 1364 area and a secondary, well, I've already labeled that target X, and a secondary hard to reach target up in the 1400 area, target X1. As part of this descending scallop construction, the market has created a possible double bottom over February to May. Thus, such a pattern would have a primary target X2 in the 1276 area with a secondary hard to reach target X3 in the 1313 area. To aid in visualizing this, I've highlighted two features on this market. Firstly, the mauve highlighted medium moving average below, currently at 1200, and the gold highlighted long moving average above, currently at 1268. Effectively, they bracket the market, and it's worth paying special attention to those below and above. Secondly, I've drawn a new dark blue bullish Andrews pitchfork for the late February to late April action. This is to help aid in ascertaining a new possible bullish angle of attack. The market is right now in between the overhead middle time, currently at 1353, and the lower time below, currently at 1207. The point of this is possibly to give some definition to the potential move higher. However, though we are close, the market has not yet fully committed to the rise. So please keep your eye on the gold highlighted long moving average overhead, currently at 1220. What the market will do once it gets up there, if it gets up there, may be crucial in deciding the commitment the market has to these bullish patterns. Chicago soybean meal. Excuse me. The market consolidated in late February this year, down at 326.90, but this congestion was different compared to earlier ones, as we had crossing through it back then, at the time, the dark blue highlighted extension to the lower trend line, currently 325.70 of the July to September 2021 descending triangle. I said 10 weeks ago, and I quote, This may be nothing, but I am minded after such a fall as we've seen since last year, that this may, just may, see some hesitation around the 327 to 325 zone. I'm not certain on that, but it's worth considering. End of quote. Well, prices utilized this extension to the descending triangle as a base and rallied back up through the 61.8% absolute Fibonacci line at 336.30 and even briefly over the then short medium moving average, currently at 330.60, before again succumbing to bearish pressure from this moving average. For a while, mainly during March, it looked like all this was within a very recent and possibly larger pattern, a March-based bull channel, but that proved soon to be a mirage. Instead, I drew a very early February, early May sideways triangle, highlighted in bright red on my daily chart. We advanced quite a way along the coil of this triangle until breaking on the upside in late April. The market then swiftly reached the primary target in the 365 even area, and soon after the harder to reach secondary target up in the 383 even area. However, once all the work was done on the way up from the sideways triangle, the market started to waver, notably being capped by a combination of the gold highlighted declining long moving average, currently at 378.10, and especially by the 50% Fibonacci line of the August 2020 to March 2022 move at 390 even. Prices backed off down to the nearest congestion area between 363.70 and 368.80, that zone, containing the October 2023 low at 366.40. And we have stayed between this congestion below and the gold moving average overhead since then. The question now is, which way will the market move? Will it take on the overhead long moving average and 50% Fibonacci line, or else the congestion zone below? Additionally, what pattern will the market take as part of its action? A topping action or a halfway hesitation? At the moment, both courses, higher or lower, are not obvious, but the choice will have to be made as each day the free area between the moving average and the support and 50% Fibonacci is gradually being squished. Finally, I will raise once again the one key feature I need to repeat and emphasize, as I have done in the past. I raised it as a possible feature 48 weeks ago, and it came to fruition at the close of 2023. It was that the whole of 2023 was an annual key reversal down last year. This potential hangs over all of this market more than anything right now, and all action should be seen in the shadow of this pattern. Chicago soybean oil. At the turn of the year, the market broke down through the 38.2% Fibonacci line of 48.95 that held up prices over November and December last year. At that time, it looked as if the market might form a very extensive bearish halfway hesitation, with potential being as low as below 40 even. However, the decline was a lot shallower than in previous moves lower. This was possibly dictated on top at the time by the green highlighted short medium moving average, currently at 46.47. Prices went down to the area of congestion we last saw in May 2023, consisting of 3, possibly 4 bands. They are 44.68 to 45.04, made up of the 2014 high at 45.04 and the May 2023 low at 44.68. Then the tight 43.80 to 43.94 zone, made up of the 50% absolute Fibonacci line of 43.80 and the April 2014 high at 43.94. Then the interesting 42.65 congestion, with the nearby neckline highlighted in bright of the October 2019 to February 2020 head and shoulders top, currently 43.68. Now, I mention all these because some 45 weeks ago and numerous times since, I said the following about the big descending wedge pattern that was on my daily chart back then and is now high up off the top of my chart. I said the following when I quote, "I would consider this descending wedge pattern may, just may, have lately morphed into a possible scallop pattern." This is a big pattern idea, and that's the end of quote. This is a big pattern idea, and the market decline since autumn of last year fits in with this idea, with the expectations I've voiced of eventually witnessing a fall down to the area of the May and June lows between 48 even and 46 even zone, which is where we've been recently. I've often stated here that I'm keeping a very, very close eye on this idea, as any significant breakdown below the 48 to 46 zone would signal the start of the rest of this move lower. I said 10 weeks ago, and I quote, So far, I am not convinced of the move, but we've seen this break lower already. No, not just yet. However, three things to bear in mind. Firstly, this is a really big pattern stretching from November 2022 to date. So do not expect any immediate sharp movements. Secondly, data indicates that about 3 out of 4 times the market breaks lower. Just be aware of that. Finally, I would like to float the idea of a recent unusual bear channel. And that's the end of that whole quote. Now, I've highlighted the bear channel dating from the start of 2023 in dark blue on my daily chart. That's currently 39.90 to 46.15. Now, I had for a while utilized the green short medium moving average as the upper bear channel line before I drew a proper upper trend line. So it was that in mid-March, prices punched up through the short medium moving average, the first time closing over it since June last year. What is more, the market continued the rise and also punched up and closed over the upper bear channel line and the 38.2% Fibonacci line, the March 2020 to April 2022 move at 48.95. And also back then, the slowly declining medium moving average, which is currently at 46.62. However, this was too much of a rise too soon, and the additional forces mustered by the significant 38.2% Fibonacci line of the March 2020 to April 2022 move at 48.95, plus the congestion area seen in December last year between 49 even to 51 and a quarter, eroded the move higher, despite consecutive closes over both the medium moving average and the 38.2% Fibonacci line. Enough that 6 weeks ago we saw the market close down below the 38.2% Fibonacci line, below the mauve-colored medium moving average, back within the dark blue highlighted bear channel, and back below the green highlighted short medium moving average. 8 weeks ago I laid out some potential targets overhead for a break of this pattern, I quote, so primary target X would be in the 49.65 area that we've almost reached, with a secondary hardest to reach target X1 up in the 51.95 area, end of quote. Well, the market reached the primary target at 49.65 and reached it again, and almost a third time, but then the market turned lower, dropping down to gather fresh ammunition at the congestion of 43.80 to 43.94 zone, as well as the bright red highlighted neckline currently at 43.68 of the October 2019 to February 2020 move, the head and shoulders top. And this is where we have seen a fresh rally start late 2 weeks ago. This move up has been enough to now tackle the dark blue upper bear channel line, as well as a combination nearby of the green short medium and the mauve medium moving averages. We have not overcome these, not as yet, but prices are trying, and that is why I've left target X and X1 still on this daily chart as potentials for this move higher. Now, I may finesse these potential targets, these two potential targets next time, to allow for the lower potential break seen in May compared to the real one in March.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.